time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. All right, we can move on to our next Your Stock, Our Take. Aaron's going to take a listener question or a viewer question on Palantir Technologies. You've talked about this company in the past, I believe, Aaron, as well. It's an interesting business, certain. They did break into profitability, I believe, and are promising that for the year. But you tell us whether it's on an adjusted basis or, there has been high, I believe, stock-based compensation in this business in the past.
Yeah, and that's what we've discussed about Palantir before.
Yeah.
It has been on the podcast, but not as a Your Stock, Our Take. It was on the podcast when we were
reference to stock-based.
What in some ways could be construed as the rampant misuse of stock-based compensation amongst software technology companies. Maybe saying misuse is a bit of an exaggeration, but certainly it's a major, for many software companies, it's the largest expense that they incur on the income statement, yet they completely factor this out in the calculation of non-GAAP or adjusted earnings. But we'll get into that in a little bit here. Certainly an interesting company. I like the space. So Palantir Technologies, PLTR on the NASDAQ, trades at about $9.50 per share. It's a $19 billion market cap. And what they are is essentially they're an analytics and big data company. So they help their clients, which include government agencies and defense and intelligence, and also corporate clients, generate insights from large data sets and intelligence from large data sets. Now, the company just IPO'd not too long ago. It was in September of 2021. So they IPO'd essentially when the technology space, the software space, was almost at its peak. It was approaching its peak before the big downturn that we saw towards the end of 2022. So at one point, shortly after IPOing, Palantir achieved a share price of $34. Since then, it's been pretty much a downhill ride for investors, along with the rest of the technology sector, I will add, declining about 72% from its all-time high down to the current level. Now, the company did release their Q1 financial results just recently. Pretty good results on face value. So revenue up 18%, non-GAAP operating income up 7%, and non-GAAP EPS up about 150%. So when we look at these numbers, certainly, not impressive growth in the non-GAAP operating income, but earnings per share, that looks impressive. Revenue looks all right. But herein lies the issue that we've faced with not just Palantir, but with a lot of software technology companies, is there's a major difference between their non-GAAP or adjusted operating earnings and earnings per share and their GAAP-based or accounting earnings per share. And whenever you see this big difference, you need to take notice and figure out what is causing the differential. So non-GAAP operating income, $125 million, non-GAAP EPS, 5 cents. But if we look at the unadjusted numbers, we have GAAP operating income of $4 million compared to 125, and GAAP EPS of 1 cent compared to 5 cents. So this is the second quarter in a row in its lifetime as a public company that it has reported GAAP earnings. In the past, when we looked at it before, we saw these big numbers with respect to non-GAAP EPS, non-GAAP operating earnings, but negative values when we factor in other expenses that they're ignoring in the non-GAAP adjustment. So really, when we look at the operating income here, 4.1 million, it actually doesn't look that profitable on a non-adjusted basis. So there's a couple things that I want to break into here in the numbers, kind of tear apart. So the first thing I think we're going to talk about here is just the difference between the GAAP and the non-GAAP profitability. And I already know what it is. I alluded to it before. It's this expense line item called stock-based compensation, which is extremely common in the software technology space, oftentimes being the largest expense that the company incurs. And this is essentially paying their employees in stock or stock options instead of in cash. So this was a great thing for employees when the stock prices of these companies were going up at historic rates. year after year after year. Over the past year and a half, it's not been so great, as in most of the technology sector, we've seen a major collapse in share prices since the peak, which again was in late 2021. Now, if we look at stock-based compensation for Palantir relative to revenues, it's 22% of revenues. So this is a very significant number. It is not their largest expense anymore, but I believe when we were looking at the company previously in our stock-based compensation segment, this number was upwards around 50% or more of revenue. So it was a major expense. Still is a major expense, but it's come down a lot. And then one of the issues that we discussed as well, just with respect to the overall software technology space, is does this underestimate the company's expenses? I mean, if they're used to years and years where they're able to pay their employees in stock and then factor that expense out of the earnings figure that they present to the market, what happens when all of a sudden employees start saying, you want to know what? I don't want stock anymore because the stock price keeps going down or it's just not going up. I want actual cash. So as this potentially happens, this is obviously increases the cash expense for these companies. Now, I don't think that we have necessarily seen this happen yet, partly because there's been a lot of layoffs in the space. So maybe employees have less bargaining power right now, but it could be an issue in the future. It is certainly one to look at. There is a major argument or debate in terms of how stock-based compensation should be handled. Some people say just ignore it. Some analysts say just ignore it. It's a non-cash expense. Others say, no, this is an expense because it results in more shares outstanding. Warren Buffett is on the side of the fence. He says you have to just consider this a full expense. You cannot remove it when calculating adjusted earnings. So this is up for debate. But what I will say, and I think that this is a prudent approach, is when there is a significant, substantial difference between the GAAP profitability and the non-GAAP or adjusted profitability, you have to take note. And it's easy, but not advisable just to ignore the one of the biggest expenses on a company's income statement. So here, major impact on the financial results. But there's another thing that I want to break out here as well. And that's if you look at the GAAP results here, operating income, GAAP operating income, 4.1 million, but GAAP net income, 19.1 million, right? So you would generally expect from an operational perspective for net income to be less than operating income because it's lower on the income statement. And when it's higher, a lot of the times there's non-cash, there's non-recurring items that are adding to that. Sometimes things that you do have to factor out in order to get a real economic assessment of true profitability. But certainly you need to know, I mean, that's unusual that net income is higher than operating income. So we need to dig in, we need to figure out why. Now, the reason why for Palantir basically comes down to interest income. So Palantir has an excellent balance sheet. They have about 2.6 million in net cash, maybe 2.9 million in total cash. Interest rates have come up, so they're now receiving interest payments on that cash balance. Interest income for the quarter was almost $21 million. And that's really what has caused the GAAP profitability, not the operations, but the interest income. Now, a lot of people will say, but Aaron, isn't this a good thing that they have a huge amount of cash on their balance sheet? Absolutely. The balance sheet of Palantir is pristine. That cash, I believe, generated largely from their IPO. But you still need to separate operating profitability from non-operating profitability. And interest on a cash balance is non-operating profitability. If they invest that capital, which we hope that they will at one point, if they invest that in assets that are generating the same return as their current operating assets, then you're not going to, making that assumption, you're not going to get great profitability at the end of the day. You're going to get less interest income, and their operating business clearly is not that profitable on a GAAP basis, right? So this is something you have to consider. It's great that they have this net cash balance sheet. As I said, about 2.9.
And you meant 2.6 billion, right?
2.6 billion in net cash, about 2.9 billion, I believe, in total cash about 260 million in lease liability. So that's net cash per share of $1.26. Pretty significant. But at the end of the day, I don't want to look. This is not a financing company, right? When I look at profitability, I want to see that the operating business is profitable and not just that they're generating interest income off their cash balance. Eventually, I want to see that cash deployed into profitable operating assets. But anyways, moving on, the company did put out guidance for the full year. They're expecting revenue between 2.18 and 2.235 billion. So that would be about a 14 to 17% increase in revenue from 2022. And then adjusted income from operations between 506 and 556, which would be growth of 20 to 32% from 2022. Now, remember again, this is adjusted. So this does not consider the share-based compensation. And they are also saying GAAP net income in each quarter. But if they're only generating a cent or two in GAAP net income, and that is primarily the result of interest income from their cash balance, it's really difficult to look at that and come up with what would be a reasonable valuation. But speaking of valuation, if we were to just take the non-GAAP earnings per share, analysts are expecting about 21 cents this year. That seems reasonable considering their guidance and considering their performance in Q1. At the current share price, that would be a price to earnings multiple of 45 times non-GAAP earnings. This is a premium valuation still. Now, once again, interesting business, but trading at a premium valuation. Our take in the end, we do like the analytics and big data business. There's a lot of potential here. They have substantial work in the government space. I believe about 50% of the revenue is government, 50% commercial. They have that beautiful net cash balance sheet, which does provide them with an opportunity to deploy capital. But they are trading at a high premium valuation. They have minimal to no GAAP earnings from current operations. And this is a concern to us. So our next steps, we'll continue to monitor Palantir. I like the idea of the business. We have no near-term plans for a recommendation at this point. There are other SaaS, software as a service, companies and AI software stocks that we prefer right now.
Yeah, that's a good summary. I mean, the company, like after its IPO, traded in the $20 to $30 range for an extensive period. So it's come down significantly. Again, it's a case of a company that was just trading at silly valuations at those levels, trying to get to profitability. But is there really true profitability there if the major GAAP EPS is really just coming from interest income, right? So the business is breaking even.
And that is
basically
the case. A lot of software companies have big cash balances.
Huge cash
balances. Some from free cash flow, others from raising money in the past when their valuation was higher. So that's good.
It's better if it's from free cash flow, but if it just came from, the initial IPO and a silly season time, like they're just it's milking a cash hoard there that they didn't even create, right? But right. I mean, obviously this company has revenues and had growth, but I mean the growth is still there. But you look at it, I think in the next quarter they're guiding towards 12% revenue growth. That's the slowest rate as a public company in its history, and their growth peaked out in March 2022 at about 57% like quarter year over year growth in their quarter then in that March quarter. So it's really come down significantly over that period. And I mean, that's why I don't know if you should pay 45 times that's non-GAAP earnings, right? Like that's a high multiple still, even if it is progressing and moving towards profitability. But like we said, it's really breaking even without that interest income. So, and there, I did read some other analysts' take on it, and one of the takes was that there was noted that some of the revenue outperformance in the quarter was driven by some special purchase or SPAC companies that went out of business, and the revenue was prepaid and pulled forward as a result of bankruptcy. So, it's a concern there if some of that revenue is not going to continue if those companies went bankrupt, clearly. So, it does seems that revenue growth is declining, and we'd like to see it increase.
One last comment I'm going to make here, and this is just to kind of, explain my perspective on why I'm not really that impressed by them making so much money off of their interest income. And that's that if you look at their cash balance and you look at their interest income, they're generating a return of about 3% off of that. Well, if I'm paying 45 times earnings for an asset, I don't want a return on assets at 3%. I want a solid double-digit return, well into the double digits, right? So that's good that they're generating some cash off of it right now, but it's insufficient. You want to see that capital invested eventually. Now, I'm patient as an investor. I believe in being patient. When companies have a lot of capital, you don't want them to rush out and invest it into something stupid, but eventually you want that to be invested into a high returning asset.
Okay, well, let's move on to our next, unless you guys had something on
I was just going
Palantir.
to say thanks for, covering that for Rom. He did send in a Facebook message and he asked exactly that. They had 2 profitable quarters recently and wondering if the valuation is high or low. You answered it perfectly. So I'm sure he'll appreciate that.
Yeah, it breaks it down to, you broke into profitability, but if you're still trading at a massive multiples of that profitability, and a good deal of the profitability is not really coming from operations. So, I mean, that's something to definitely consider.